Position sizing for successful trading. Position sizing is a crucial aspect of trading that, while not a technical indicator in the traditional sense, plays a pivotal role in managing risk and optimizing potential returns. Proper position sizing ensures that traders do not expose too much of their capital to any single trade, regardless of their confidence in a given trade setup. Position sizing refers to determining the amount of an asset to buy or sell in a particular trade. It's about deciding how much of your capital you're willing to risk on any given trade. By managing this aspect efficiently, traders can control their potential losses and ensure they don't jeopardize a significant portion of their trading capital. Position sizing helps traders do the following. Manage risk. By only risking a small percentage of your trading capital, you ensure that no single trade can significantly draw down your account. Maintain emotional discipline. By knowing and accepting the potential loss before entering a trade, traders can maintain emotional stability, reducing the chance of rash decisions based on fear or greed. Achieve consistency. Using a consistent position sizing method allows traders to achieve more predictable results over time, rather than having wide fluctuations in account equity. How to trade it. Several methods and guidelines can help traders determine appropriate position sizes. Fixed percentage method. With this method, traders decide to risk a fixed percentage of their capital on each trade. For instance, if your capital is $10,000 and you decide to risk 2%, you'd risk $200 on any given trade. Example. With a $10,000 account, risking 2% means you can have a stop loss that's $200 away from your entry. If you're trading a stock at $50 and place a stop loss at $48, you'd buy 100 shares because 100 shares asterisk $2 per share equals $200. Dollar amount method. Here, a trader decides to risk a fixed dollar amount on each trade, irrespective of the account size. This method can be less adaptive as the account grows or shrinks. Example. Regardless of account size, you might decide always to risk $100 per trade. Volatility-based method. This method uses the asset's volatility to determine position size. For instance, one might use the average true range as a measure of volatility and decide to risk an amount equivalent to 2 times the ATR. Example. If a stock has an ATR of $1 and you wish to risk 2 times the ATR, then you're risking $2 per share. If you've decided to risk $200 total on this trade, you would purchase 100 shares. Kelly criterion. This is a more advanced method that uses the probability of win and the reward-to-risk ratio to determine the optimal position size. However, traders should be cautious and often use a fraction of the Kelly recommendation to avoid overexposure. Mental stops versus hard stops. While deciding your position size, determine if you're using a mental stop or a hard, automated stop. Hard stops automatically sell the position at a predetermined price, while mental stops require manual execution and can be prone to emotional decisions. In conclusion, proper position sizing is essential to manage risk and trade sustainably. Always predetermine your risk and position size before entering any trade.